This Friday, a new coordinated silver buying campaign is being organized across social media platforms like Reddit, X, and Discord. The main goal of the campaign is to buy physical silver, take delivery, and put pressure on bullion banks by reducing dealer inventories and exchange stockpiles. According to organizers, more than 127,000 participants have already joined the movement, and each participant is being encouraged to purchase at least 10 ounces of silver. If everyone follows through, more than 1.7 million ounces of demand could hit the market at the same time. The big question now is whether retail investors can actually create a real silver squeeze, or if institutions are already prepared for it. A retail silver squeeze happens when thousands of small investors coordinate together to buy physical silver or silver-related assets at the same time in an attempt to create shortages and drive prices higher. These campaigns are usually organized through social media communities. Supporters believe that if enough silver is purchased quickly, bullion banks and commercial traders may be forced to cover their short positions, which could push prices sharply higher, especially if the market is already tight. A similar campaign took place in 2021 when silver surged from around $25 to $30 within weeks before eventually cooling off again. That event proved that retail enthusiasm can move markets temporarily, but long-term price direction still depends heavily on institutional positioning. There are two major types of silver rallies. The first is an organic rally, which develops naturally because of market fundamentals such as industrial demand, inflation concerns, monetary policy changes, or supply shortages. These rallies usually build slowly and tend to be more sustainable. The second type is a coordinated squeeze, where large groups of retail investors attempt to create rapid momentum through planned buying campaigns. The 2009 to 2011 silver rally was largely driven by quantitative easing and fears following the financial crisis, while the 2021 Reddit silver movement was fueled by coordinated retail buying. History shows that organic rallies tend to last longer, while coordinated squeezes often struggle to maintain momentum. Looking back over the past 15 years, several retail silver squeeze attempts reveal a very clear pattern. The 2011 campaign became highly successful because commercial traders were heavily short-positioned at the time. Retail investors aggressively bought silver, and prices climbed from around $27 to nearly $49. Institutions were caught in a weak position and were forced to cover their shorts as demand increased. In 2013, another campaign was launched, but this time commercial short positions were already much lower and inventories were abundant. Silver prices briefly moved higher before quickly collapsing again. This showed that when institutions are already prepared, retail buying pressure can be absorbed without causing major market stress. The 2021 retail silver movement achieved partial success. Thousands of investors coordinated purchases, and silver rallied nearly 20% in just 2 weeks. However, the move failed to sustain itself over the long term, and prices eventually stabilized. Another silver raid in 2022 also failed to create lasting impact because institutional short exposure was already relatively low. What makes the current 2025 setup so interesting is that commercial traders are now holding only about 6,800 net short contracts, one of the lowest levels seen in recent years. This creates two possible scenarios. The first possibility is that institutions already reduced their shorts in advance and are fully prepared to absorb retail demand. The second possibility is that institutions reduce their exposure because of genuine delivery concerns and may now be vulnerable if physical demand suddenly surges. If retail buying accelerates while inventories remain tight, silver prices could move sharply higher. This is why many analysts believe the current campaign could either fail quickly or trigger a much larger market reaction depending on how institutions respond. Large financial institutions also have several tools they can use to counter retail squeeze attempts. They can aggressively sell futures contracts to suppress spot prices even while physical premiums rise. Dealers can increase inventory before the campaign begins to prevent shortages. Premiums on silver products can also be raised sharply to discourage buyers. Some demand may be redirected into ETFs instead of physical silver, and mainstream financial media may ignore or negatively frame the movement. If institutions successfully use these strategies, retail momentum could weaken very quickly. Over the coming days, investors will be watching several key indicators closely. Rising dealer premiums may signal strong physical demand. Products selling out could indicate real inventory tightness. A strong move in spot silver prices may suggest institutional weakness. Open interest data will reveal whether institutions are adding new short positions or avoiding additional exposure. Media coverage will also matter because mainstream attention could attract even more buyers into the market. These indicators should reveal within the next 72 hours whether the campaign is gaining real traction or being contained by institutional countermeasures. If institutions are fully prepared, retail demand may simply be absorbed, leading to only a temporary price spike before the market cools off again. In that scenario, excitement fades and prices often retrace lower within days or weeks. However, if retail demand overwhelms dealer inventories and institutions are unable to aggressively increase short positions, silver prices could rise rapidly. While this type of scenario is rare, it becomes possible when market fundamentals are already tight and institutions are caught off guard. In the end, history shows that retail silver squeeze campaigns produce mixed results. The most important factor is not retail excitement but institutional positioning. When institutions are heavily short and vulnerable, retail pressure can have a meaningful impact. When institutions are already prepared, retail campaigns often create only short-term volatility. The current market setup is unusual because commercial short positioning is near historic lows, which is why the next few days could become extremely important for the silver market. What happens now will likely determine whether this movement becomes just another short-lived social media trend or a genuine disruption in the global silver market.